All right. Good morning, everyone, and thanks for being here. Bill Powers and I are mining stock educators, and we are very happy to bring you this Prospera Energy update from CEO Samuel David and CFO Chris Lutz. Several weeks ago, we were able to visit Prospera, go out to one of their fields, watching Samuel in his element and observing the team that he has built. I believe that Prospera is on the right track, and I am confident they can keep production high throughout the winter. So let's hear directly from Sam and Chris. Sam, Chris, welcome.
Good morning. Good morning, Kerry and Bill. How are you?
Very well.
Can you guys hear us fine?
Yes.
Good.
So you can begin the presentation, Sam?
Oh, okay. I was waiting.
Yeah, it's your time.
Okay. All right. Sounds good. Okay. Good morning, everyone. Thank you for taking your time to listen to our webinar. And I would like to present an update on our development and the resulting production from the development and where we're at and where's Prospera heading. Prospera has been fairly active this year. Let me just move the slide. And in executing the phase 2 of our development plan, as you recall, the corporate strategy had 3-phase development, 3 phases to the development plan in restructuring the company that began in quarter 1 of 2021. And phase 1 consisted of just going after the lower hanging fruit of optimization and bringing operations to safe operating conditions and being compliant with regulatory and environmentally and bringing the books to up to date. As a result, the company increased its production in the phase 1 from 80 barrels to about 800 BOEs per day with another 200 barrels behind pipe. And it raised it delineated the entire field and appreciated the net present value of the company by interpreting 3D and doing geological delineation and looking at all the legacy data, and increased the net present value of the company from $3 million to $72 million. And also it raised its LLR rating, license liability rating, about 1. And we attained free cash flow from operations as the break-even point is about 500 BOEs per day. We reduced the operating costs from 60 plus barrels per day to $38 per barrel. Now it's approaching $33 per barrel. And we also piloted a couple of horizontal wells to assess the transformation of the field to access the significant reserves in the ground that we have estimated. That's nearly about 400 million barrels of oil in place for the entire company, and mostly it's concentrated in these 3 heavy oil fields. And we also completed a light oil asset in Brooks, and that development is commencing as well. And we conducted a very detailed audit to bring the books up to date. So that set Prospera in a position to start developing and capturing the significant oil in place and appreciate the production. And that's what has been happening in phase 2 of this year, phase 2 that was being executed this year. We proposed a development plan of 10 horizontal wells and also develop Brooks with slanted wells as well to increase production and add about 1,000 BOEs per day. And so that is the update that we're presenting. Now, as we're doing our phase 2, there's always phase 3 as well. So the phase 3 is providing support energy to the reservoir to reduce the decline as we are developing the field with horizontals. We also want to provide energy and to maintain sweep to the producing wells. And that's also incorporated in this development plan as well. So as I mentioned, we are in phase 2 and we have executed 5 horizontals and actually 6 horizontals now. We have resumed our production. So I will go to that slide right now. Here's some pictures of activity that's been going on in the field and with our strategic partner, Lasso Drilling Company and their associates. So you can see in the bottom left-hand corner, we're trying to execute multi-well pad. So we're taking as little space as possible and have as many wells possible on a single lease and reduce the number of lease. So we reduce the environmental footprint and also reducing operating costs and property tax as well. And you can see here's right at the drilling derrick office, and we have execution of the drilling in this corner and another view of it. And here's Dave Hempsing, the president of our drilling company as well. There's a very good collaboration with all the service providers. As a result, we have some really good results because of this collaboration. There we go. George, you want to talk about, well, I'll start off with here and then George could probably, are you there, George?
Yeah.
George is our VP of subsurface. You want to talk about this plot that I have here that we developed together, all the color schemes and all that?
Okay, so the map on the left. So the maps are illustrating the separate pools within the Cuthbert area, and some of the numbers that we've got written there are the key one being that each of these pools is about basically a 10% recovery factor. So the pools are outlined with the black lines. What you see in the orange circles is kind of our evaluation of drainage of oil from the pool. So at the end of the day, those drainages are telling us that there's a lot of oil in between the existing wells that have been drilled. So the vertical wells that have been drilled. The pool outlines are defined by both seismic, geophysics, and the geology. So we put those two together. And I think if we go to the map on the right, it's illustrating where we've drilled horizontal wells. And the five or six horizontal wells that we've drilled in the south are in the green. They're the green lines on your map on the right.
So as George mentioned, in these, the orange is what estimated is the drainage area for those vertical wells. These are heavier oil, 13 to 15 API. But the viscosity is good, but it's very porous and permeable. Regardless, the heavy oil does not move too far. You have to have reduced spacing, lots of reduced vertical spacing in order to access the heavy oil. In that orange, and there's a little green circle, and then in the orange, the green circle indicates where it's drained more, and the orange says that's probably areas of communication a little farther out and less reserves been recovered, but there's still there's communication there, but it's not fully drained. So you can see there's a lot of oil in place in between that's undrained, and that's our estimation. So we drill these wells carefully placed by seismic 3D seismic in between the wells to see if we are accessing undrained reserves. And later I will show you that we are. So as I mentioned, with the collaboration, all the service providers, with all the technical work that's been done, we drilled 6 horizontals now, and the first 5 horizontals were drilled here, and in the South Pool, and they encountered structure and pay as we expected, due to the well control and the 3D seismic we have. So we placed the wells within meters of what we anticipated to be, and it was well done by the entire technical drilling team, and also managing the porous, permeable, somewhat unconsolidated reservoir and depleted reservoir as well. We also obtained an average lateral pay of about 422 meters in those first 5 wells, and the drilling was tweaked by the pilot wells, so we had lots of efficiency in drilling the well. We drilled the wells within a day less than what we anticipated, and under budget by nearly 15%. It's about 13%. As a result, here's a little picture on the shaker, the oil flowing in while we were drilling. Even though it's overbalanced drilling, we still had received fairly good oil show. And as a result, the performance of 3-month performance shows that we're some of the higher lateral pay performed well above the type curve that we anticipated. So we are on this. We're tracking our type curve, our anticipated type curve per estimation by analyzing all the horizontals that was drilled in this area, and the type curve was derived from it, and economics were performed based on that type curve estimation. And I think we did the estimation around $70 a barrel of pay or price. In these, we noticed that laterals that is greater than 500 meters of pay performed extremely well. We're in 110, and it's maintaining pretty good production. Lateral pay less than 300 meters, and we had to stop in 300 meters, not because we wanted to, but we encountered some geological surprises, not surprises, mineralogy differences that we know, and getting closer to the water lake. So we thought it's best to keep in the best pay, and it could be optimized, but that's the initial performance. But either of those categories of wells have not been optimized. They're running at a very low RPM with a lot of joints of fluid in wellbore, but we want to ensure that we induce lower drawdown, not higher drawdown, pulling on the heavy oil and pulling in the water. So we're extremely happy with the performance of the wells and what we have encountered and what we're receiving, what the performance is. So based on these first 5 wells, we have commenced our second group phase of drilling, and these wells are plan to drill an average of 700 meters, so we can have really good IP and good recovery. But getting beyond those 700, even drilling 700-meter wells in these reservoir conditions where it's porous and permeable, and it's depleted, the longer you stay in the lateral pay, the longer you're in there, you're about to encounter more problems and challenge of getting stuck and sloughing in, these kind of issues. So it is a fine balance how far you can go, but the performance so far indicates that there's an optimum level around 500 to 600 meters, but we are planning of average of 700 meters. And I think the first well of the second group that we have drilled, we stopped at 503 meters of pay. So second group of phase has begun, and we're gonna continue to drill till March of breakup throughout the winter. And in this picture here, this is a northern pool. We have shown on I think the one in the red are the wells that are being drilled right now. And there you can see all the additional wells that are planned, and we'll continue to drill and exploit the reservoir and access all these undrained reserves while providing support for those producing wells. So you can see the color scheme. Some are blue, some are green. The red is also green, but that's being drilled right now. The blue is going to be converted into injector, initially to be drilled as a producer, and then it will be converted to injector, and injecting fluid that is appropriate and conducive to the fluid conditions and the reservoir conditions of these wells. And that's being piloted soon, probably in the first quarter of next year. So the development has expanded and extended, and it's continuing based on some good results. And so that's what's happening with the heavy oil. George, do you have anything to add to that?
Yeah, the only thing I was going to add is that this next phase of drilling is in a separate pool from what we drilled in the first phase of drilling, which you mentioned already. So this will be production from in a separate pool.
That's
as
right.
we drill these 5 or 6 wells.
Yes, the reason being, when we go, that's a very good point, George. The reason being, when we go to drilling these wells, we have to shut in all the producers in that well. So we're producing in the south. We have put the wells in the horizontal wells in the south pool, and so we can't go and shut down again and to drill a well. So we're going to shut down this pool, and that's what we say production shutdown, so we can drill all these wells. We are bringing these wells on fairly quickly, within 2 or 3 weeks of completion of completing the drilling, or rig released, and then we'll do the completion and tie in within 2 or 3 weeks. As I showed you in the previous picture, they're all on an existing pad here, existing pad, and there's a lot of facilities here, so we're able to get wells on fairly quickly within 2 or 3 weeks turnaround. And this is the south pool that was shut in, and we drill these wells. Now the pool is back on. We'll come back to it once we finish the north pool to shut in and drill the rest of the wells. So that's what's happening in the heavy oil. And in the medium light oil well, we have here's a picture of a lease that is already constructed and ready for drilling and licensed. And you can see it's a good place to drill. We're not disturbing too many trees or anything. It's flat land, and this is just a rainstorm drainage area, and it's useful. Due to environmental constraint, they have indicated we cannot put many wells, as we were planning to drill from one location on this picture, to drill all 4 wells and just maintain one lease. Instead, we have to get more leases to drill these wells, and that's being developed right now. It's being prepped right now as well. For the end of the year, we expect two wells to be tied in that is standing right now. One well tested at 100 barrels a day, another well tested at 300 barrels a day, and then we're ready to drill this location, and 4 others are being prepped, and hopefully we can drill it by end of the year as well. But we'll continue this development into the next year as well. There's about 20 wells locations have been identified, and there's more pools being developed. So that is the update, the production update. And so as a result, this is how the wells, how this area has been performed over the years. This is where Prospera began its restructuring, and this downfall here was the severe winter. And due to all of this production, we are nearing our target, and we expect to attain our target by end of the year, 1,800 BOEs a day. Currently, we're sitting here with the shut-in production and the producing production, and behind the pipe is not so much included here. If we do add the behind the pipe, we will be a little bit more, but we expect to attain our target for exiting target for this year at 1,800 BOEs per day. Currently, we're producing about 1,100 BOEs. As I showed you, we have to shut in production to accommodate the drilling. There's about 400 BOEs per day shut in, another 300 plus 400 BOEs a day, or 300 BOEs per day behind the pipe. That only requires minor repairs and optimization. However, having said that, we are turning away from putting on a 10 barrel a day or 15 barrels a day by changing pump and things like that. We're beginning to shift and transform into horizontal wells that is going to give us 100 plus barrels per day as we are optimizing our drilling technique and locations, and more and more get away from trying to optimize smaller producing wells. Because our joint venture are about 10, I would say an average of 15% joint venture partners are receivable. They haven't been able to pay their bills, and they're in default. So consequently, we are Prospera is assuming 100% of the production. So when we go say gross production, that's what Prospera is actually getting, even though our net average is probably about 80% working interest. And that's what we show in the books because that's what we're supposed to. But in actuality, we're producing, and the revenue associated with this not also shown in the books. But 100% of the payables is shown in the books. So it always payables seems more, less production, less revenue, 80%, and receivables are higher. But in actuality, the reality is Prospera is assuming 100% of the production and the revenue and the payables as well, that is not reflected in the books. So Chris, you want to expand a little bit more on that and go to the next one?
Yeah, Sam, you're right. I mean, since effectively Prospera is carrying a receivable amount of over $3 million on the books for a couple of partners that are delinquent at this point. So on a monthly basis, Prospera is managing, the gross revenue amount rather than what it's reporting on a net basis. And of course, yes, it's carrying the gross payable amounts on the books as well. The slide that we're looking at here now is really an update from a slide that was presented about 3 months ago. And so it's an update on the funds that were available for the Prospera drilling program. Excuse me. And so, from the information that was presented previously, Prospera has shown operating netback of 1.5 million through the periods of August through October, and projecting about 3.6 million from November to December. So over 5 million of the drilling program is actually funded from the company's existing cash flow. There were existing funds available on hand when the program was commenced at 1.3 million. And Prospera is in the process, had received overwhelming interest on debt funding of 3.6 million. So this exceeded the amount that was announced in the initial offering. And warrant funding as well of $3 million, of which 1.5 has already been exercised. So a total of 13 million of funds is available to support the horizontal and the vertical drilling program. The change from the biggest swing from the information that was presented last time, as you point out, Sam, is that the partners are not funding this program and have elected not to participate on the wells so far to date. And so we've seen that amounts removed, replaced with the debt funding program here. That's
one comment. Not only they not elected to participate, they don't have the option to elect to participate because they already have arrears that they have not paid. So they have to pay those arrears before they can participate in this program. So they have to settle all their arrears before they can participate. So
Yeah.
you want me to change to the next? Yes.
Yeah, I may as well go on to the next slide, Sam. So again, this is a slide that was presented previously with Q1 and Q2, and Prospera announced its Q3 results at the end of October, which are included in the information here. So to go through that, as the company continues to transition through its from vertical to horizontal technology, since the beginning of the year, you're seeing continuous progress on the income statement. So production is increasing, revenue is increasing, operating netbacks are increasing as well. And Sam and George, as you guys point out, that the field, the Cuthbert field and certain pools were partially shut in during the drilling program here that was commenced in the month of August. However, still reported stronger results compared to the 2 quarters prior. So total production on a gross basis, 766 barrels a day. And keep in mind, these are averages for the month, so the numbers are increasing. Production on a net basis of 613 BOE a day, and the reported net sales number of 519 BOE per day. The difference between the production, the net production and the reported sales, of course, take into consideration inventory and consumption of natural gas that's being used as fuel for lifting oil out of the ground. Reported revenue is $4 million, so an increase of over $1 million from the prior quarter and significantly up from Q1. Royalties are trending up, but as a basis of revenue at $400,000. Operating costs were slightly higher during the quarter, driven by a couple of items. Some vegetation control, which normally takes place in the summer months, so taking care of a lot of the weeds on site. Facility desanding and injection volumes optimization. There's some winterization costs that were also incurred in the quarter as we prepare for the upcoming winter as well. So leaves with Prospera with an operating netback of about $1.6 million, which is an increase of over $500,000 from the quarter before. We're seeing a continued exercise, as I mentioned on the slide before, of $1.5 million. No debt funding reported in Q3, however, will be reported in Q4 based on the slide that we've seen before as well. So Prospera is continuing to manage itself and produce the cash required to be able to fund the upcoming drilling program, but also being conscious of operating results and reporting a positive net income of just under $100,000 for Q3 as well. Anything I missed there, Sam, you wanted to talk about?
No, I think we're constantly appreciating and putting the monies back into the ground and have lined up a source of funding to continue our program. And with the collaboration of very good service providers, we're able to continue this development and increase production and capture some significant reserves. Now, the capturing the significant reserves is going to have a very good positive effect on the net present value of the company at the year-end reserve evaluation that is commencing soon. And that'll give you a very good uplift on the NPV for the company.
Are we ready for questions, gentlemen?
Sure. Yes.
First question. First question, Sam. How can investors be confident production won't fall this winter contra last winter?
First of all, you can anticipate very harsh cold winter because that comes every year around. And when it's minus 50, everything starts stalling things. So we are expecting to have our production a little bit more, and then we have kind of budgeted for it to come back. That's why we have 1,800 BOEs a day, and we expect to be a little bit more. And I'm sure there's, we have budgeted about 20% or something like that. in there for production to fall back. So that's why we have set our target to 1,800 BOEs a day. And also we have done a bunch of work over this summer and continue to do work on winterization and also calibrating equipment that can anticipate and have a shutdown quickly so we can fix things and get on it. So we're far more prepared, and we have budgeted for the little short reduction due to cold weather as well.
Okay, next question. When do you begin drilling horizontal injection wells?
These wells that are where we are drilling are, some of it will be converted to injection wells. They are all of them drilled as a producing well first. We produce first for 6-8 months, and then we convert them into injectors. And in the facilities as well, all of these wells are designed from a location that already have injection line flowing to it. So we're knowing that we will convert that well into injectors. So though some of the wells that we're drilled now, maybe one or two, George, you probably can add, one or two will be converted into injectors after 8 months of production or a year of production, depending on how much production it gives. But yes, these are all strategically drilled and aligned to be alternate producers and alternate injectors.
Is Prospera giving guidance for barrels per day production for 2024?
We anticipate, if we continue with this development and the pressure support and some of the acquisitions that it is in progress as it is, we're speaking right now. There's addition to this core area that we're doing the heavy oil drilling, and there's also a light oil acquisition. As a matter of fact, Bill and you and I think we're going to meet soon on that in Houston as well. If all of those come to fruition, I think one could expect we could be in the 3,000 plus barrels per day, BOEs per day.
What is the latest status on polymer flooding and nano particle injection?
That's an interesting question. Who's that coming from? We have been studying all of these kind of fluid for injection, and we're doing more studying than a lot of other people, and testing as well. And I don't want to make comments on polymer effectiveness or nano, but one thing we could say, we're reservoir engineers and reservoir management people, and one thing we believe in is introducing foreign material into in situ could have some immediate impact, but it could also have a long-term ramification. So we tend to side with more fluid that is natural to that reservoir that is already there, and providing energy. So we have a combination of some pressure support reservoir management plant, and it's in the testing phase in the labs, and also we're going to pilot, and that is a big aspect of our third phase development plan that we have planned as we optimized, and then we transformed the field, and infrastructure and everything is set in place, and these wells are all drilled strategically with the interwell distance and for reservoir conditions all taken into consideration. And the third phase is providing energy, could optimize the recovery quite incrementally, substantially, probably into 20-30% if we do it right. If you put if you look for some immediate impact, you're not going to get that kind of recovery factor in the 20-30%. You want to be able to do that continuously with the infrastructure, and what that translates into is op costs below $10 or $15 a barrel, and continuous steady production and with very low decline. That's what we're driving towards.
Okay. Chris, perhaps this question is for you. What is the timeline for the closing of the planned debt funding?
Thanks, Bill. We'll look to close that here in the month of November.
Okay. Chris, here's another follow-up. Do you expect the partners will ever be able to be in good standing and pay their way?
Actually, I should answer that one.
Okay.
But go ahead, Chris, give it a shot.
Well, I mean, sometimes these discussions take a little bit longer to work out here. Obviously, money owed is money owed. There are partner interests and things like that, and there's obviously different settlement strategies that can be employed. It's not always just cash in those settlements, and we're working through multiple different avenues to try and settle out the differences.
I think Chris should be a politician. That was well said.
Okay.
Chris, I would have said that, there's a pattern. Historically, they have not been able to keep up with the development plan, and always looking for some sort of deals, reduction, cents on the dollar to get back into the game. And I think that is not, that's not correct.
Chris, so when will on the balance sheet that be reflected not as a receivable but actual production if they're not expected to pay their fair share anytime soon?
Well, it'll be reflected after the settlements are finalized, Bill. We would expect, probably in the next couple of quarters to have.
Okay. And here's another working capital partner question. What is the penalty for working capital partner defaulting on payables?
300%.
Yeah, 300% if there's no participation on new development.
Okay. A question on the Aduro partnership. Phase 1 was planned to be completed by December 2023. Is that still the case? And if so, will we get an update in January 24?
Aduro's ability or Aduro's objectives are well received by especially bigger companies like Conoco and Shell. So there has been a very good demand for their testing to see if they can appreciate the oil quality. So that they've been inundated with higher demand of testing. Meanwhile, we're a smaller company. We have made partnership. They're also testing, but they're a little bit delayed. And we do expect actually good results, I believe, because of all this demand with the larger companies that has a very good high interest in Aduro's ability. We expect little delays, but we expect some results earlier in the first quarter of next year.
Okay. I have a couple questions from existing shareholders, which I'm going to combine, and they're expressing the desire for more awareness, investor awareness regarding the story. Can you elaborate on any plans to make Prospera more widely known?
Prospera is been slowly, steadily increasing our market awareness, meaning we're putting a little bit more funding for the market for the marketing awareness, and but most of the funding has been going to the drilling and appreciation production, and but we are looking at increasing funding for market awareness and increase our marketing exposure.
Okay. Is there a preliminary plan for when drilling in Lutzland and Hart Hill would start?
We're focused on Cuthbert this year, but I do believe we're planning to commence. We already have locations in Hart Hills next because that has more infrastructure as well. Lutzland, Lutzland has the lower, is most depleted, and it's the highest reserves reservoir. So there has to be some pressure management appreciation in Lutzland prior to commence drilling. Otherwise, we have to go into underbalance drilling. But even if you do drill, you still need to increase the pressure, pressurize the reservoir in order to increase the capture. So I think Harts Hill probably in summer of next year, because you don't want to commence operations in the winter, in the spring there. And in this, we also going to pilot our pressure support in loose land and in the first quarter. So I think towards the end of the summer, we can start commencing development in loose land.
Sam, this question has to do with the scalability of Prospera. Have you expanded employees? Will you be able to operate as a larger company? Is Matthew Kenna still with the team?
Oh yes, we do have to make that announcement, Chris. There's an announcement coming. Matthew Kenna is going to be transitioned into the director position, and Chris is going to be transitioned into a CFO position, previous Matthew Kenna's position. And we are, our Prospera is a very technical team, and we use technology to our best of our abilities. So we don't need to add a lot of people, a lot of employees in order to be a 10,000 barrels a day company. And modularly, we will add people as we add more assets, because the teams are dedicated to an asset or assets. Yes, this company modularly can grow into a large company.
So I might also add, you've got a couple of consulting groups that we work with, Bill, that we can add services, that utilize services from, to be able to take advantage or to be able to benefit from when we're drilling wells and certain things like that when extra services are required.
That's a very good point. George can add to this. When we do a development plan, talk about when we do a development plan, how do you come up with a well, George?
Well, it was interesting how you gave me direction. So when the development plan was created, we're setting wells up for the whole pool. We're not just looking at part of the pool, we're looking at the whole pool. And what would we do from start to finish on one particular pool? So taking into account, the spacing of the wells, the infrastructure that we have already with regards to pipelines, reusing existing leases. We're trying, to decrease our environmental footprint. By drilling the horizontal wells, we reduce the footprint by getting rid of vertical wells and using existing leases so we don't have to take out more land. We had to incorporate that all right at the beginning when we came up with the whole plan for a particular pool. So it's all I don't want to say set in stone, but it's solidified to a very great extent at this point as to what we're going to do. And we just do it gradually over time.
Exactly. So what we're saying is when we're initiating these development, we look at the entire full development case. So we're set locations and where we want to exploit initially and thereafter, meaning we coordinate our services accordingly. So these services are continuing the service, and there's a volume discount, and they're also happy that they have steady services to provide over this entire plan, over a year or 2 years or 3 years. Yes, we have strategic consultant and partners in place, and they're our partners. And when we convey to them, we communicate to them what we're doing and how we can alter things. Just like I showed you in the development plan, we're tweaking from how many meters is this optimum locations, and we show all the locations that are coming up. So they work with us. So there's a good collaboration and a strategy in place that we all work together.
What is the status on any automation of new wells to reduce operating costs and better runtime?
Say that again. What was that question again?
I just deleted the question when I asked it, but it was about the automation of the wells to reduce costs and increase runtime.
Automation is we're leaning towards that, but automation also has a capital aspect to it before it reflects on operating costs as well. And as we showed you in those pictures, these are all multi-well pad, and yes, automation is the correct way to go to have a real-time indication of what is happening, and so we can reduce downtime and attend to any troubleshooting that's necessary. So automation is in the picture and it's in the progress.
The second answer to that question is the fixed cost reduction strategy, which is being employed across the fields. Although those results also aren't reflected immediately. The property tax reductions sometimes take 8 to 12 months to be able to see in the financials. And the surface lease cost reductions also require a little bit of time because the abandonment and reclamation processes that are associated with them. Certainly are reflected in the 2 to 3 year plan, but as we drill the horizontals, those are really the triggers to be able to start a lot of those processes.
Okay. What % increase in 2P NPV10 after year-end 2023 reserve calculation by Insight do you expect?
I always hate to give out numbers and then they come back and say, oh, you came short. But I expect to increase NPV above $100 million. Right now we're 75 million.
So total 100 million, just to clarify, not an additional 100 million, but
total. Increase it by another 25 million plus.
Okay. I still haven't.
To it.
Okay. Still have a number of questions here. What would be the anticipated ARO exiting 2023 and then 2024? Thank you.
We have a LMR, liability management program, that we have shown that as we drill the lateral, we're abandoning the vertical locations. And each year we have estimated to retire 40 locations. I think we've done 60 plus locations so far since the last year we took over, and we have 40 to abandon this year, 40 next year. And what is that ARO reflection to? And also we're planning reclamation, full-scale reclamation next summer. Probably about 100 locations, 100 plus locations, and those all going to have a tremendous ramification on ARO and under the OPEX as well. So what is a 40 well? Probably $1 million plus this year, and and then another couple of million less next year. So the ARO is going to be tremendously reduced over the next 2-3 years.
Okay. Will acquisitions be funded through debt versus further share dilution?
I'll take the first part, Chris, before Sid. We have a good, luckily, fortunately, very good interest in many sorts of different types of funding, as and because we're elevating our NPV value, and the acquisition also elevates the NPV value, and the market cap always lags a bit, but the market cap could also go a little higher. So I think we could do a combination of debt plus equity. And also, our cash flow is increasing as well. So there's many sources of funding. I think a combination is probably what could be optimized for acquisitions.
Okay. And can you give any update on the acquisitions that have been targeted?
In terms of, well, one is expanding in the core area. That it's very similar to what we're doing, so we can just carry on in that area, and we can use the existing services that are there and operators and etc. operation team as well. Another one is in a light oil that's existing pool that's just in primary depletion, and it's like 40 API. And that can be optimized a fair bit, and it could be improved recovery as well. And they all add to the product mix of Prospera in elevating it from heavy oil mix with the light oil mix, increasing our pricing and margin as well.
Will Prospera be purchasing the remaining roughly 20% that is in receivables?
We'd like to have a settlement, which could be increasing our working interest, and if the partners desire to retire their settle their remaining working interest, Prospera will also be interested as well.
Okay, still have a number of questions here. We have about 10 or 15 minutes. Will this group be running Prospera in 10 years, or do you expect to be taken out by a bigger company?
I don't know. You have to ask God how long I'm going to be around. But I intend to carry on. I think this is probably a good time to convey my relationship with these other gentlemen here. George and I go back about 35 plus years. We always hold it at 35. And Chris and I over 20 years, 2 or 3 ventures, and so I don't see why not carry on and try to increase Prospera's shareholders value.
Okay, next question, trying to do a little more rapid fire here. What is the difference between the 400 million barrels of oil in place and reserves? Will the current plan wells capture the oil in place?
Current wells, no, we have to transform, as we have indicated in our phase 2. We have to transform from a vertical to horizontal to access all the undrained reserves. So we have about 100 locations of transformation, and at the same time we have to provide reservoir management methods to increase recovery.
Okay, are there any learnings from Strathcona Cactus Lake that Prospera is using?
Yes, we do utilize. We look at all our analogs, all our surrounding wells, and similar reservoirs that are similar to our reservoirs internationally as well, to expand our understanding and our application to the improved recovery methods.
What are the plans with singular wells Prospera owns in Red Earth and North Alberta areas?
Very good question. It is a bit of a distraction from our core areas, and we're trying to optimize those wells, and we are very close. We have a better understanding. It was a little complicated. All right, George, the Red Earth with the different sands, and we're optimizing it, and we're at that point we can hold it steady, and hopefully somebody would be interested in divesting it.
Are there any thoughts as to instituting a hedging program to protect from a large oil price drop in 2024?
It's interesting. The other day it was a large price increase and large price drop, but however, production stability is fairly important, and initially we would be concerned, You know, within this year, we have maintained certain production. So I don't see why not a certain percentage of a production that is stable that we can deliver so that we're not penalized. We will be looking into hedging to maintain certain price scenario.
Okay, the wells that are being plugged, do they have no further economic utility, or are they just low or marginally producing wells?
Well, I think our team all assess it in every which way. We look up and down, sideways, and the infrastructure or anything like that. And before we retire these wells, George, you can comment on that.
Yeah, that's definitely the case. I mean, we want to see if there's any other hydrocarbon within the wellbore. And if there's no other hydrocarbon and we're not using these wells for re-entry anymore, they have no value to us. So we can go ahead and abandon them and take them off our books.
Okay, does the continuation of the horizontal drilling program delay any possible acquisitions?
Certainly not. If anything, it helps it.
Okay. Is the new production from the new wells at risk over the winter, or has you already kind of answered this question. Is the new production at risk over the winter?
No, I mean, the weather doesn't care whether it's new production, old production. You know, everything is subject to it.
Okay. On the production chart, perhaps you want to put the production chart back up if we could on the screen. What is the yellow bar? Is that not production, and or when can we expect those barrels to be added?
Yellow bars, those are all PEI horizontal barrels per day added as we get going. This chart needs to be changed up a bit, but it takes a bit of work. But it's a continuation of horizontal well drilling and Brooks development as well.
I think what the viewer is asking is perhaps on the bottom line with the years should move a little to the left, perhaps, is what's behind the question.
Oh, okay. You mean you a little to the left, you want to go earlier in the years, or to the right?
No,
right.
In other words,
right.
Yeah, so what's represented with the yellow spike is actually more into 2024.
Yeah.
Okay.
I think that Hartshill, loose land, all of these acquisitions and all that coming on.
Okay, so that was what was behind the question. What is the estimated total BOE recovery for each well?
The primary depletion in the primary without pressure support is, we were saying 100 IP and 100,000 barrels to recover. But if we're getting into improved recovery, which we are, enhanced soil recovery, pressure support, these things could recover in the 200 plus, even 300,000 barrels.
Okay. What is the reason the 100 barrels a day and 300 barrels per day light oil wells were not brought online in 2022?
It is obtaining environmental pipeline license, and we had both are shared leases with the company that gave us the well, and they expect us to get a new lease, and these were all in the environmentally sensitive areas. Go ahead.
Yeah, environmentally sensitive areas.
Yeah, that took a long turnaround for them to give us answers, and it's a very delayed process. So these are all volunteers in the area, and they're usually in and out, and then they meet at a certain time, so on and so on. So yes, it was out of our hands.
But those are the two wells that are going to be now connected in the near term, right?
Yes, those are, now we have finally obtained some acceptance.
And how many at Brooks with the light oil, how many wells do we expect to drill before March, the thaw?
Before March. George, you want to take that one?
I will take that one. I I think if we get things lined up, and we're working on it, we've got someone working on this, I'll say 24/7 now. We should get in the order of 5 to 6 wells. I mean, we have an inventory of 20. Depends on how aggressive we want to get with that 20. But to get 5 or 6 wells done in 2 different pools, I mean, we could be looking at, I don't want to push it too hard, but 750 to 1,000 barrels a day.
Okay. Don't listen to him. Because then I'll be held responsible for it. But yes, there's good optimization. Those are very good production potential wells, yes.
And then, George, what about Cuthbert? How many wells do you think we can drill until the thaw?
Oh, I mean, let's say each quarter is 5 wells, 5 or 6 wells. So this quarter, we're going to add, what are we doing? Another 6, Sam? And then next quarter, we could do another 6.
Okay.
Yeah.
I think that's how I'm looking at it.
It's weather dictating, regulatory dictating. As you can see, these leases, we have to prepare leases and things like that. But we have large inventory of wells, and we're going to continue the development.
Okay, well, we're at our hour. Carrie, if you could come back on. Thank you very much, Sam, Chris, and George, and I'll hand it over to Carrie.
Thank you, Bill. And gentlemen, thank you. It was very informative and further makes the case, the investment case for Prospera, which I believed in for quite a while, which is why I invested in the company. So that's it for now. For more information, go over to prosperaenergy.com, sign up for notifications. All of you, thanks for attending, taking time out from your busy days. If you have any further additional questions, just send them off to me and Prospera will get back to you very quickly. And that's it for today. Thanks for attending.
Thank you, Bill and Carrie.
Thank you.